Picture a tightrope walker suspended between two skyscrapers. One building represents catastrophic loss, the other, generational wealth. The rope beneath their feet, that's silver at $72 per ounce, and we're watching them take their final steps right now. What happened on January 3rd, 2026 wasn't just another market fluctuation. It was the lighting of a fuse, and that fuse has a timer, 8 days. Let me explain why the next week will determine whether you're about to witness one of the greatest financial opportunities of this decade or one of its most brutal wipeouts. Think of silver's recent journey like a mountaineer attempting to summit Everest. Last March, they began their ascent from base camp at $72. 9 months of grueling climbing brought them within striking distance of the peak, $83.20, a height silver hadn't touched since November 2024. On January 3rd, our climber reached for the summit. They touched $83.32. Success seemed inevitable. Then, something went catastrophically wrong. Within 72 hours, they'd tumbled 8% down the mountain, leaving behind what chart technicians call a double top. Think of it as 2 failed summit attempts in rapid succession. Here's what makes this fall different from a routine retreat. Our climber is now dangling from the exact same ledge where they started their entire journey. That $72 level isn't just another waypoint, it's the launching pad that made the whole 150% rally possible. It's the difference between safety and a 1,000-foot drop into the abyss. Now, imagine walking into a casino where 247 people hold winning lottery tickets, all claiming the same $1 million jackpot. The casino only has $1 million in the vault. You wouldn't call this a lottery, you'd call it a crime scene. Welcome to the silver market. According to January 6th data from COMEX, the exchange where silver trades, there are currently 247 paper contracts claiming ownership of every single physical ounce sitting in their vaults. This isn't a metaphor. This is literal accounting. 5 weeks ago, that ratio was 180 to 1. In just over a month, 67 additional paper claims appeared for every real ounce. We're watching a game of musical chairs where 247 people are circling a single chair, and the music is about to stop. Think about what this means in practical terms. Either 246 out of 247 people discover their silver doesn't actually exist, forcing paper prices to collapse, or the one real ounce becomes so valuable that its price must rocket upward to satisfy the mob fighting over it. There's no middle ground when you've sold the same asset 247 times. Here's where this story gets fascinating. And while retail investors were celebrating silver's climb toward $83, a very different drama was unfolding behind closed doors. Between January 2nd and 6th, precisely as silver was failing at 83 and stumbling toward 72, commercial traders added 15,000 new short positions. These aren't amateur speculators gambling their savings. These are institutions with names like JPMorgan Chase, with access to vault inventories, order flows, and market intelligence that would make a poker player salivate. They're betting on $72 to fail. But here's the twist that reveals the true genius of institutional positioning. JPMorgan isn't just betting against silver. Simultaneously, they've been accumulating physical metal like a doomsday prepper stocking their bunker. Since December 20th, they've added 4.2 million ounces to their vaults, bringing their total hoard to 187.3 million ounces. That's 6 times the entire deliverable inventory available on COMEX. Read that again, because it's the Rosetta Stone for decoding what's really happening. Long physical, short paper. This is like watching a fire chief bet against a building while secretly buying fire-resistant safes and filling them with valuables from that same building. They're not confused. They're prepared for either outcome. If paper prices crash to $56 while physical metal becomes scarce, JPMorgan's mountain of real silver appreciates even as their paper shorts generate profits. If prices instead explode to $91 because delivery demands overwhelm available inventory, their 187 million ounces gain roughly $3 billion in value, dwarfing any losses on their relatively modest paper position. They've engineered a scenario where they win regardless of which direction the market moves. The question haunting retail investors should be obvious. Have you? Let me take you back to 2 moments in silver's history that ended in catastrophe. January 17th through 18th, 1980, silver peaked at $49.45 in back-to-back sessions, failed to crack $50, then reversed violently. The crash that followed wiped out fortunes. April 2011, silver formed a double top at $48.70, failed to break through, then plummeted. Another generation of investors learned painful lessons about momentum reversals. January 2026. We're watching an identical pattern unfold at $83. 2 attempts to break through resistance, 2 failures. An immediate reversal. But here's the critical difference that transforms this from a simple historical repeat into something potentially apocalyptic or historically profitable, depending on which side you're positioned. In 2011, when silver last formed this pattern, COMEX vaults held 103.9 million ounces of physical metal. That substantial buffer allowed the paper market to function normally during the crash. Traders demanding physical delivery could get their metal. The system bent, but didn't break. Today, COMEX registered inventory stands at just 31.2 million ounces. That's a 70% collapse in available physical metal since the last time this technical pattern appeared. Think of it like this. In 2011, the lifeboats on the Titanic could hold 1,000 people. Today, they can hold 300. But there are 3,000 passengers on deck, and everyone just heard the iceberg strike. On January 1st, 2026, while most of the world was nursing New Year's hangovers, China quietly detonated a bomb in the global silver market. New export restrictions now require Chinese silver exporters to demonstrate annual capacity of at least 80 tons and meet stringent purity standards. According to industry analysis, these requirements instantly disqualified approximately 90% of smaller Chinese exporters who previously supplied Western markets. The impact was immediate and brutal. December 31st, 2025, Shanghai silver traded at a $2.80 premium over COMEX spot prices. January 6th, 2026, that premium exploded to $6.15, a 120% increase in 6 days. This isn't market noise. This is the sound of a supply chain snapping in half. Here's why this premium matters more than most investors realize. When Shanghai trades at a $6 plus premium over COMEX, arbitrage traders can buy physical silver from COMEX vaults, ship it to China, and capture the difference as pure profit. And that's exactly what's happening. Approximately 400,000 ounces are draining from COMEX registered inventory every single day to feed this arbitrage. Do the math. 31.2 million ounces divided by 400,000 ounces per day equals 78 days until COMEX vaults are theoretically empty. But markets don't wait for inventory to hit zero before reacting. They panic long before that. Which means COMEX faces a binary choice within days, not months. Either crash paper prices below $70 to make the arbitrage unprofitable and stop the bleeding, or spike prices above $90 to close the premium gap by matching Shanghai's pricing that reflects genuine physical scarcity. There's no stable middle ground when inventory is vanishing this fast. Let me give you the exact mechanism that will force this market's hand. Options expiration on January 15th, 2026. On that date, 67,400 call options expire with strike prices between $75 and $85. Each option represents 5,000 ounces, meaning these calls collectively claim 337 million ounces of paper silver. That's 10.8 times the entire registered inventory currently in COMEX vaults. Simultaneously, 43,200 put options expire with strikes between $60 and $70, representing claims on 216 million ounces. Think of this like two massive armies positioned on opposite sides of a battlefield, waiting for a single gunshot to determine which side charges and which side retreats. If silver closes below $70 by January 14th, one day before expiration, all those put options between $60 and $70 become profitable. The dealers who sold those puts must hedge their exposure by selling futures, adding 216 million ounces of selling pressure to an already damaged market. This creates a cascade effect. Momentum algorithms detect the breakdown. They add their own sell orders. Stop-loss orders get triggered. More selling begets more selling. The mathematical target? $56 to $58, where maximum put interest is concentrated. That becomes the gravitational center pulling prices downward as dealers aggressively hedge their exposure. Historical precedent gives us the timeline. The 1980 crash took 12 trading days to reach its low. The 2011 crash took 14 days. If $72 breaks decisively this week, mid-February 2026, specifically around February 20th, becomes the projected window for reaching the $56 range. Now picture the opposite outcome. Silver holds above $72 through January 15th. Those 67,400 call options between $75 and $85 remain in the money. Dealers who sold those calls are now short 337 million ounces to call buyers who have contractual rights to demand delivery. The arithmetic is savage. 337 million ounces of in-the-money calls. 31.2 million ounces of available inventory. That's a 10.8 to 1 mismatch between claims and metal. If even a small percentage of call buyers demand physical delivery instead of cash, the system simply cannot satisfy those demands. Dealers must either cover their shorts by buying futures, driving prices higher, making more calls profitable, triggering more buying, or source physical silver from outside the exchange at premiums that make the math work. Neither option ends quietly. Historical commodity squeezes typically accelerate when prices break above the highest concentration of call strikes. For silver's January 15th expiration, that acceleration zone starts around $85 and extends to $91.50, where Fibonacci projections and technical resistance align. If $72 holds through expiration and silver reclaims $76 to $77, dealers will need to hedge aggressively. That buying pressure in a physically starved market could easily blast through $85 and trigger a self-feeding squeeze. The projected timeline? Silver could hit $91.50 by January 28th, just 13 days after options expiration. That's the historical velocity of commodity squeezes when inventory constraints prevent normal market function. Here are your exact trigger points, the specific prices and dates that will tell you in real time which scenario is unfolding. For the crash scenario, 2 consecutive daily closes below $70.50 confirm breakdown. The relative strength index momentum already turned negative on January 5th. The moving average convergence divergence printed a bearish crossover that same day. The target is $56.40, the 0.618 Fibonacci retracement level. The timeline is mid-February 2026, approximately 28 trading days from the January 3rd peak. For the squeeze scenario, hold above $72 through January 15th options expiration. Reclaim $76 by January 17th to confirm momentum shift. Break above $85 triggers dealer hedging acceleration. The target is $91.50, the 1.618 Fibonacci extension. The timeline is January 28th, 2026. The extended target if the squeeze continues is $105 to $110, the 2.618 extension. Remember those export restrictions? Chinese industrial demand continues accelerating. Solar manufacturers alone consumed 185 million ounces in 2025, with 2026 projections exceeding 200 million ounces. You're watching supply constriction collide with demand expansion, collide with technical breakdown, collide with inventory depletion, all at the same moment. This is what market theorists call a perfect storm, except both outcomes, collapse or explosion, qualify as storms. The only certainty is that something massive is about to happen. JPMorgan's split positioning, long physical, short paper, reveals something most investors miss. They're not betting on direction, they're betting on dislocation. If paper crashes while physical premiums keep widening, you're looking at permanent bifurcation. Western paper markets and Eastern physical markets will trade at completely different price levels, potentially for years. Their physical holdings benefit from scarcity premiums. Their paper shorts protect against nominal price collapse. It's a strategy that only works when you know the unified market structure is fracturing. That's the real genius of institutional positioning. They recognized the double top wasn't just a technical pattern. It was the detonator for a market structure that's been deteriorating for years, finally reaching its breaking point. Between now and January 15th, 8 days, silver will declare its intention. The market will choose between validating 40 years of technical precedent with a crash or invalidating that precedent by demonstrating physical shortage has become severe enough to overwhelm bearish patterns. Institutions positioned for both outcomes before most investors recognized the double top had formed. They accumulated physical while silver climbed. They added paper shorts as the pattern developed. They're already protected. The critical difference between institutional players and retail investors is timing. Institutions positioned before the binary choice became obvious. Retail investors are still trying to decide whether to buy, sell, or hold while the decision window is closing. By January 15th, the decision will be made. The mathematics will have played out. Silver will be moving decisively toward either $56 or $91, with institutions capturing profits in both directions while everyone else scrambles to understand what just happened. This isn't about predicting the future. The future is already determined by forces in motion. Inventory levels, options expiration, technical patterns, supply restrictions, and arbitrage flows. All that remains is watching these predetermined forces collide and resolve. That tightrope walker we started with, they're taking their final steps right now. The rope beneath their feet, $72, is the only thing preventing a catastrophic fall to $56 or a spectacular leap to $91. One building represents watching months of gains evaporate in a technical collapse that mirrors every historical precedent. The other represents witnessing a short squeeze that rewrites the rules of how paper and physical markets relate to each other. The institutions have already crossed to safety. They've hedged both directions. They've positioned to profit regardless of outcome. The only question that matters now is this. When this market makes its move, and it will make it within 8 days, will you be reacting emotionally after the fact? Or did you position yourself before the calendar and mathematics executed their inevitable conclusion? Because by January 15th, the answer won't matter anymore. The trap will have either sprung or failed. And silver will have chosen its path, with or without you being ready for it. The invisible tripwire is about to be crossed. The only question is whether you saw it coming.